Boy, oh boy, you must have a lot of questions these days, right? Some stocks goes up, some stocks goes down, and then you have a lot of volatility, a lot of uncertainties, and even better, the Bank of Canada, the Fed, they're all saying, inflation is still not under control. We might increase our rate. So what are you going to do with your portfolio? How are you going to manage this? Are you going to hold on to your losers for more time? Today, we're going to look at how I review my portfolio step by step just to make sure I'm on the right track and I invest with conviction. So let's go inside DSR and I'll show you how I manage my portfolio quarterly. All right, so welcome to my DSR Pro dashboard where I can see my portfolio, and in this case, we're gonna look at my pension plan. So pension plan, that was money that was invested since 2017. It's in a locked-in RRSP, so a Lira account, which means I cannot add more capital to this portfolio. I can only manage what I received from my previous employer and make it grow. So for the record, I received a check of like $107,000 and then I invested, no, 108, sorry. 108, now it's worth a little bit more than 215, so almost $216,000 6 years later. And I'm going to show you how I review my portfolio to make sure it's on the right path all the time. So the first step I do is I will go see my allocation. But before I jump on my sector allocation, I want to make sure that I'm good with my asset and currency allocation. So that's the very first thing. You want to make sure that you're on the right track and you have decided either you want to be like fully invested as I am. As you can see, I'm like 100% equities, a little bit of cash, but that's just like dividends that have not been reinvested yet. I do prefer to invest my dividend myself to rebalance my portfolio instead of dripping, but I have nothing against dripping. So you can drip, you can use the dividend to reinvest in the same stocks, or you can do like myself, keep a very small amount, but at the second I see more than $1,000, I take that $1,000 and I rebalance my portfolio. So for some people, they might say, well, 100% equities is way too much for me. I want to have some bonds. I want to have some GICs. Our platform actually supports it. So you can actually add those to your portfolio. You can add those income as well. So you'll be able to project your income in the future. And you can also reduce volatility by having bonds or GICs in your portfolio. So on that side, very quick for me, I'm all in, invested all the time. It's been 20 years I invest this way, so nothing has changed under the sun. The second thing here is I have my currency allocation. So I try to get a balance of 50% in Canada, 50% in the US. As you can see, not always the case, unfortunately. I'm at 42% Canadian stocks, 58% US exposure. Two things explains that, and you'll see that in the sector. The first one, I have a high exposure to the technology sector, and obviously the US currency is taking more and more space, obviously, and it's getting like more value. So this explains why I'm a slightly debalanced. If I reach above 60% here, I know that I will have to sell some US stocks and buy some Canadian ones. That's just because I want to make sure I maintain this balance. The balance is not something that is a rule or an obligation, but for myself, I set that target to be 50% US, 50% Canadian. You can change that target for your portfolio. It's not really important. The importance is to have a target and to make sure that you maintain it. Then we'll go to the sectors. Sector allocation is super important because it will determine if your portfolio did well this year or not, and pretty much all the years, right? So as you can see, I have a lot of exposure to financials, but we're gonna see that in a moment because 29% in financials is definitely a bit too much to my taste. I try to have maximum 20% in each sector, like 20-25% will be in my favorite sectors. And for all the others, I will try to have like something around 10%, but sometimes it could be like as little as 2.4 or 2.8 or 3.6 for materials. So this means I only find one interesting company. I don't necessarily want to have a big exposure to that sector, but if I find a company I like, then I'm going to invest in it. So let's go back to the two largest sectors that are more than 50% of my portfolio, financials and technology. So for financials, I'm going to look here and see which stocks is taking that much, and make sure that within that sector, I am well diversified. So for financial, I have Brookfield Corporation, that is a alternative asset manager. That's a very interesting business, very long-term capital thinking. The business is investing for the next 50 years, not for the next 50 days. So it's important to put that in mind. They have a huge track record and they invest in several type of businesses. Then I have Visa, which is a payment processor, and we could argue that it's probably like 1/3 financial, 1/3 technology, and 1/3 consumer cyclical. So if people don't travel, obviously Visa and MasterCard are not going to make a lot of money. And if their network is not that great and their technology is not that great, well, merchants will not choose Visa as one of their payment processor. So again, good diversification, not much link with Brookfield Corporation either. Then I have BlackRock. So BlackRock, another asset manager, but a little bit different than Brookfield. So while Brookfield invests in big long-term assets, BlackRock is more a classic one, creating ETF and investing in equities on the stock market in public companies. So then again, I have a slight diversification between BlackRock and Brookfield and no link with Visa whatsoever. And the last two are the banks. So I have Royal Bank and I have National Bank. So overall, even if I am invested a lot in the financial sector, I do not have 5 banks. Having 5 banks meaning that I have one market event, such as a housing crisis and a mortgage crisis, and boom, 28%, 29% of my portfolio is at risk. In this case, if I have a problem with mortgages in Canada, well, I have Royal Bank and I have National Bank that will be affected, but Brookfield, BlackRock, Visa don't really care about the housing market in Canada, right? So this is how you can diversify your portfolio within a sector with multiple industries. For the technology sectors, I have 3 companies. So TXN, Texas Instrument, semiconductor, and then I have Microsoft that are building software and they work a lot in the cloud. And I have Apple that is making the smartphone and all other electronic equipment. So again, they're all tech stocks, but they're not exactly in the same business. So they're less correlated than if I had Broadcom, Texas Instrument, and Taiwan Semiconductors that are all making chips, then I would probably have a little bit of too much exposure to semiconductors. In this case, it's not what happens. So when I look at my portfolio, as I said, I want to maintain a balance across all sectors. I want to have roughly 20-25% in my favorite sectors, and the important here is not to invest in all sectors. Actually, you don't have to have the 11 sectors in your portfolio. As you can see, I don't have any energy sector, and I have a very, very small exposure to materials, industrials, and communication services in that sector. Even REITs at 4%, not that much. Why it's not that important? Because it's important to understand the sector you invest in, how they react to the market and to market events, and to feel comfortable. So if you don't understand technology stock, maybe it's not for you, and then you can move on to another one. And if you have a strong experience in the real estate, maybe you want to have more REITs in your portfolio. But this will be dictated by your interest and your knowledge and your comprehension of the sector. So far, I'm satisfied. I just take a mental note. I don't want to see this going to 30%. If it's ever the case, I'll have to trim some of my position. Same thing with information technology, but for the rest, I have 13% in consumer discretionary, 12% consumer staples, 8% utilities. So this is all good. The second thing I'm going to look at is my ratings. The ratings are great, but they don't tell you everything either. So it's important to put that in perspective. You should never buy or sell based on a rating. So at DSR, we have 2 types of ratings. But again, if you ask any financial analyst, we have all different point of views on different stocks and different strategies. So the rating will be an indicator. Of course, I'm happy to see a lot of green in this screen, but it could be something different. So here I have most of my holdings are either rated 5 or rated 4, and I have nothing else. So I know that all my portfolios in green light. At this point, I'm just going to feel good. I know I did my due diligence way before going those into ratings, but if I had 3s, 2s, and 1s, I would do a little bit more research to decide if I agree with DSL rating or not, making sure that this is like the stock I want in my portfolio and I feel comfortable with it. But I have some example with the dividend safety score, because as you can see, I have some yellow and red here. So those are red flags I must look at. So here I will see I have Magna International. I have $5,000 in this one. So it's a small position, but nonetheless, not the strongest dividend safety score. Then I would go on doing more research on Magna International. I'm going to do that in this video because it's already long enough, but I would click on the stock card. I will read the analysis and I will notice that the latest dividend increase this year was a lot smaller than the other. So it was previously rated as a 4. Now it's rated as a 3, just to show that there's a slowdown in the dividend growth. So nothing to worry about right now, but still not the best stock in my portfolio, that is for sure. Now, I do have 2 major red flags, which are Disney and CAE. And both of them are classified as dividend trash, which is obvious because they suspended their dividend back in 2020 during the COVID. So back then I understood. And I thought, well, it makes sense. It's prudent management. So I'm going to keep those 2 stocks, even though they have cut their dividend. Before the pandemic, they were both thriving. If they were not been thriving before, meaning that you have like revenue growth, earning growth, and dividend growth for several years, I would have probably sold them. But then I decided to keep them, making an exception and see what's going on with those 2 companies. Fast forward today, I'll make a decision in December if I keep those 2 or not. Because obviously they're red flags in my portfolio. Disney has not been performing. There's a lot of things going on here. I'm not going to do the full analysis, but just to show you how when you look at your stocks, you see bad ratings, then you go back to the stock cards, you look at the metrics, and the important part when you analyze a stock is to make sure that your investment thesis, the narrative behind the reason why you bought a stock, matches the numbers. So my investment thesis for Disney is it's the business with the largest library of content. They have so many stories, so many characters. They can do so many movies and then TV series and apparel and park theme and cruises. So they have this way to use those characters and stories and create multiple streams of income. So that's the investment thesis. On top of that, they decided to build their own streaming services, attracting more customers, being able to expand their library of content and creating like their exclusive content. So they are the only one that have those license, which makes them even more appealing. So that's the investment thesis. That's the reason why I invest in Disney. Now the problem is when I look at the numbers, I see that revenues are growing. After the pandemic, they picked up and that's going well. Park themes are going well, movies are going well, but the problem remained the streaming services. And streaming services has become a huge burning cash machine. So we usually like money printing machine. We don't like cash burning machine, right? So they have to put billions and billions right now to create content, to support the platform, and it's not profitable, which brings the earnings lower now than they were before the pandemic. And this is becoming a serious problem. So now you see that my investment thesis and the numbers, they don't match up. And what I'm doing in this case is now I set up a date. I let 23 went by to see if they were able to recover, not on the stock market, but the numbers. Are they able to sustain the number of subscribers and make it profitable at Disney Plus? And so far, it has not been it's not been the story. So the next step is next quarter, if I don't see any improvement, I'm just going to sell it because it's been a long time now. It's been more than a year that my investment thesis does not match my numbers. And it doesn't really matter if I'm making money or losing money at this point. The point is focus on your strategy and make sure that you follow your investment process. For CAE, completely different story. So during the pandemic, they suspended their dividend. They quickly turned around. They made acquisition at the end of 2020 as like we had the vaccine and we felt that things are going to get to normal at one point. Now they're showing more revenue growth, more earnings growth, but they still haven't reinstated their dividend. At this point, I am making money with CAE, so it's a positive in my portfolio. Yet, At the end of this year, I'm also going to sell CAE if they don't increase their dividend, if they don't actually pay a dividend. So the reason being, I'm a dividend growth investor. This company may be doing well, it may be a good company, and I'm making money. It's not in line with my strategy. If it's not in line with my strategy, I'm going to clean it up right away. Why? Because if I keep making exception like this, in 5 or 10 years, I'll have a bunch of stocks and a bunch of sectors that has nothing to do with dividend growers. And then I'll feel like I have a big garage cleanup to do, and I won't feel like it. Because when you enter in your garage and you see all those boxes that are piled up everywhere, you don't feel like doing anything, right? So that's the biggest problem. So instead, I'm just going to decide next quarter, they have like one last chance to reinstate a dividend. And if not, boom, you are gone. Another thing that I do is I go to see my dividend diversification. Of course, I'm 42. That part is not as important for me right now. But if you are close to retirement or you are retired already, looking at your dividend diversification is key because you want to make sure that your source of income is well diversified, and you certainly don't want to see a huge part for your biggest payer. So as you can see here, I have National Bank, which is not my largest holding in that portfolio, but it is my largest dividend payer, with 11% of my annual income will come from National Bank. The next one is Brookfield Renewable. After that, I have Granite, and then I have Fortis, and then I have BlackRock. So as you can see, while most of my portfolio is either in financial or in technology sector, which is like 57% of my portfolio, I only have 2 stocks in my top 5 largest company paying dividend that are part of financial and none in technology sector. So my dividend diversification is a lot better, meaning that if I suffer a dividend cut, my income will not suffer that much. Because, I mean, it happens. I'm making mistakes. You're making mistakes. If I was perfect, you know what? I would not spend my time doing videos, and would just invest my money, and I would be making a lot more money this way, right? So jokes aside, it's normal to have bad stocks in your portfolios, but the key is to minimize the risk. So you want to minimize your sector exposure. You want to minimize your dividend exposure, and you also want to minimize your stock exposure. So that is super important. Obviously, now I could look at my dividend forecast and dividend calendar, but I'm not interested that much into my the income I'm going to receive in the next 30 days. What I want to do in my quarterly report is to minimize my risk and making sure that I'm well invested. So I did that with the sector allocation, I did that with the ratings and the dividend diversification. There's one last step. It is to look at my portfolio detail. And here I'm going to classify them by weight, because I want to make sure that I'm not overweight in specific stocks. As you can see, Alimentation Couche-Tard, big surprise. One of my favorite holdings is also my largest holdings, but at 12%, it's definitely too much. So I have 12% here. I have 11% in Microsoft. Those 2 companies are overweight according to my own rules. Again, you can decide your maximum weight for a stock in your portfolio. That is completely arbitrary. On my side, I decided it was 10%. So every time a stock goes above 10, I take a mental note throughout the year. And at the end of the year, what I do, and I decided that I do most of my trades in December. So in December, I will cut a few percent, I will trim a few percentage out of Alimentation Couche-Tard and Microsoft. So maybe like 3% for ATD. I want to bring it back to 9. Probably 2% again for Microsoft. Maybe 3 as well to bring it close to 9% as well. And I'm going to reallocate that money across my portfolio, because as you can see, most of my position after that are around 5-6%, but I do have very small position. Here, I already know that CAE is about to get sold probably, and then Walt Disney as well. So I need to make a decision with Magna International, probably increase this position a little bit. Maybe CCL Industries, only 3%. And maybe I'm going to benefit from the major drop that Brookfield Renewable went through this year to increase my position and average down my cost. So that could be interesting. We'll see how it goes. But those would be the major moves that I can make. And I want to end that with looking at the stock cards for Disney, just to show you what it looks like when you are on DSR and when you try to match your investment thesis with your dividend triangle. So as you can see here, I do have revenue going up, so which is great, but earnings are not going up since the pandemic, which is a big problem. And obviously, I do not have any dividend here since 2019. So in 2020, it was suspended and that it was over. So what the story here is, the company is making more sales, but they fail to maintain margin, meaning that you need to find the explanation why the company that raised their sales, making more revenue, are not able to make more money out of it. Because you can see between 2013 and 2019, it was going up pretty much at the same pace as revenue. So everything was fine. And then boom, major problem. They invest a lot of money into streaming services and they're not able to generate any profit out of it. So if you have enjoyed this video, give me a thumbs up, subscribe to the channel, and let me know your questions about your portfolio review, when you do it, how you do it, which tools are you using. Maybe we can share that in the community. And oh, don't forget, on November 2nd, I have a webinar called Dividend Income for Life. Dividend Income for Life webinar is all about creating that source of revenue for your retirement and not having to be stressed about it. So a lifetime dividend income, and it's coming with an innovative approach that you probably don't suspect. So subscribe now. The link is in the description below, and we're going to see each other next Thursday for our next video. And until then, don't forget to stay invested.